Hello and welcome to my final InvestEngine portfolio update for the tax year 2024-25. In this video, as usual, we're going to run through the portfolios, but in particular, as it's the end of the tax year, we're going to review the performance, how it's done over the past year, my current allocation, the ETF breakdown, possible changes going forward, how I've utilized my allowance, whether I have any allowance remaining, and also with my SIPP, the tax relief that I've benefited from, and the final contributions I've made with tax efficiency in mind. There's quite a lot to go through in the portfolio, so we're going to jump straight into it. I'm sure if you've looked at your portfolio at all or listened to the news at all this month, you'll know it definitely hasn't been good for the stock market. And unlike last month, it's not just US stocks that are doing poorly. This month, European markets, UK markets, and American markets are all down. So in the stock market, there's not really been many places to hide. So here we are in the portfolio. As you can see, the current total balance stands at £32,720.56, or a total return from my portfolio since I started of £2,104. That has taken a big hit over the past couple of months. A couple of months ago, this was maybe even nearly £5,000. It's quite amazing how quickly things can change in the stock market, but it's all part and parcel of the journey. So the first thing to note here is you can see my remaining allowance is £20,993.81. Now that's above the 20k overall allowance because it's a flexible ISA on InvestEngine. In the start of the tax year, I withdrew some money from a money market fund for a short-term goal, so that got added on to my allowance. However, if you take into account my contributions to ISAs on other platforms, my lifetime ISA, that's about £17,500. So if you take that away, I've actually got about £3,500, give or take, left of my allowance. And unfortunately, I'm not going to be able to utilise that this tax year, but I'm still very happy with how much of my ISA allowance I've used overall. Going forward in future tax years, I definitely don't think I'm going to be able to come anywhere near as close as maxing out the ISA, but we'll see how it goes. So I'll jump into the main ISA now, and you can see here, once it loads, that the current total balance is £23,079. On the maximum chart, you can really see that big dip we've had in the last couple of months. And if we just switch to that 1 month view now, we can see over the past month alone, down by 7.1%, £1,765. So yeah, I think even more negative than last month. It really hasn't been a good time to be an investor. If we switch to the 6 month view, we can see it's actually only down by 2.44% over the past 6 months. So yeah, still in the red. Actually, a lot of this negative performance over the last month or so has kind of just undone the gains of the last 6 months rather than being a major crash yet. We don't know what will happen in the future, but me personally, as a long-term investor investing for decades, it's really not something I think twice about. But I do think it is important to do these monthly updates because it shows you those fluctuations in the market. It's not always green. I think we were spoiled for about nearly 2 years now of just green, 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 maybe the odd red month, but nothing major. So this is the first major dip that we've had for over 2 years now. So for some investors, this may be the first dip they're seeing. I say dip rather than crash because I think at the moment it does count as a dip rather than a crash. For a crash, people commonly say it has to be minus 20% from all-time highs. And I'm not sure we're anywhere near that yet, but who knows? We'll have to wait and see what happens with the tariffs, recession, and general market sentiment. Okay, I'll switch back to that 1 month view now and just scroll down to the ETF so we can see how they're done. The first thing to notice here is that GGRG and XDEQ, the two quality factor ETFs, are nearly down by the same amount, minus 6.5%, minus 7%. So GGRG, despite having that dividend paying filter and commonly been seen as a more defensive option, actually hasn't weathered this downturn too well. And I do think the interesting thing for me with GGRG is that it's kind of rebalanced at the wrong time. So for the past couple of years when we've had Nvidia absolutely flying, it had Nvidia at like a 0.1% weighting in the ETF. And then I think 6 months ago or whenever it was, it rebalanced and Nvidia got a greater weighting, about 2% in the ETF. So it rebalanced to have that greater weighting in Nvidia after Nvidia had already shot up. And then now when it had Nvidia at a 2% weighting, obviously Nvidia has now been tanking. So it kind of has rebalanced at the wrong time, GGRG here. As you can see, if we scroll down to the holdings, you can see that Nvidia now has 1.6% weighting. So I'd guess before the recent downturn, it was about 2%. XDEQ, as I say, is slightly down more than GGRG, but it is closer than I thought it would be. Another quality factor ETF, this one doesn't have a dividend filter, but it does have a sector neutral filter, meaning the sector weightings don't deviate too much from the standard MSCI World, which in a sense does kind of cap the quality factor in a way. So I'm not too much of a fan of that. But as I'll mention at the end of this segment, there is another ETF that I'm planning on switching to if and when it gets added to InvestEngine. Not 100% decided, but it's probably going to be the one that I switch to and simplify the portfolio. Finally, as a fan of that quality factor, I do want to reduce the number of ETFs. And the reason why it was so many ETFs at the moment is just because there was never a single quality factor product that I was completely happy with, but never one that I was 100% this is the one for me. So We'll have to see if I can simplify that portfolio going forward with some new ETFs. But anyway, XDEQ, you can see the reason why this probably did slightly worse is it does have slightly greater weightings to those tech companies than GGRG. Next up is UC99. So this is basically, you can think of this as the S&P 500, but with a quality filter. This is down by nearly 10%, so really not a good month for this. And if you click into it, we can see why. Scrolling down to those holdings, Apple, Nvidia, Microsoft nearly having 25 to 30% weight between them. So they've all had a poor month. So this ETF is going to have a poor month when it has 30% in just those three stocks. Next up, emerging markets. This is also down by 3%. So as I say, in the stock market, there's not been any place to hide here. It's been developed markets and emerging markets both down over the past month. And then lastly, small caps have done very poorly over the past month. So small caps, as I always say, are more sensitive to any sort of economic data, recession, interest rate, any sort of news like that. Small caps are more responsive usually than large caps. So with all the fears and uncertainty over the past month, they're down by nearly 10%. So not a good time to be a small cap investor. I can show the stocks in this one, but there's a limited point because as it is a small cap ETF, it's unlikely you've heard of any of these companies. They're not big names. And then now if we switch to the maximum view, we can see my portfolio now is up by 20.62% on a time-weighted return basis since I started in April 2023 when I transferred from Hargreaves Lansdown. So the portfolio has taken a massive hit, there's no doubt about it. But as I say, it's part and parcel of the journey with investing. It's not something I panic about or worry about. Instead, I just think about how I'm going to maintain consistent contributions, thinking forward about how much I can contribute each month, think about any change I can make to the portfolio. Nothing major. I do like global exposure. But if newer ETFs are released, newer products that I like the look of, maybe make some changes. And that is what I'm thinking of doing going forward. So as you can see at the moment, I've got 1, 2, 3 quality factor ETFs. So it'd be ideal for me to simplify that down from 3 just to 1. And there is a new ETF by WisdomTree called WisdomTree Global Quality Growth, WGRP. I'm not affiliated with them in any way. It's just an ETF that I like the look of. And it's basically like GGRG, but it doesn't have a dividend paying filter. It has quality and growth filters and includes both dividend and non-dividend paying companies. And I think for me, it is the quality factor product that kind of does all these 3 things in one. Yes, it will be more volatile than GGRG, so to say, but I'm not too concerned about volatility. And simplifying the portfolio is something I'm more keen on. But again, I've not decided. It's just an ETF I like the look of. I will be keeping an eye on it and seeing if it is something I add to the portfolio. Another ETF that I like the look of that has been added recently is AVSG. This one is on InvestEngine at the moment. This is a small cap value ETF. So this is the only small cap value ETF that trades in GBP in the entire UCITS market. So it's great to see that on the platform. So if I did want a super simple factor investing portfolio, AVSG and WGRP are 2 ETFs that I really like the look of. And maybe that's what I'll do with my portfolio going forward. As I say, I'm undecided at the moment. They're just 2 ETFs that I like the look of. And as someone who's interested in factor investing, they are something that I do like. And I do keep my pension and soon to be in my trading 2-on-2 ISA, I have the standard market cap weighted global funds. So if I can have that bit of fun with factor investing, maybe get a small premium over the market, maybe not. That's the thing with factor investing, no guarantees. But it is something, as you know, I talk a lot about on this channel. So whenever there's new ETFs that have these factor exposures, it's always something I'm going to take a look into, research, and see if it has a place in my portfolio. So now we're in my SIPP, my self-invested personal pension. This one has a balance of £9,641.07 at the moment. Over the past month, it is down by £663.24 or minus 6.64%. And you can see I have made some contributions over the past month. So here we had 2 buys for £50. So that was tax relief from earlier contributions that landed in my account. And I just invested that tax relief straight away. And then recently, in the last day or two, or the day of recording actually, £300 on the 31st of March. And basically what I decided to do was just any income above that 50k mark, I've just put into my SIPP to get that tax relief, because I get the 20% tax relief added automatically by InvestEngine. And then I can also use it to reduce my self-assessment tax bill, as it is income that falls in that 40% tax bracket. So if you're someone looking to reduce your tax bill or top up your retirement savings, it's definitely worth looking into a SIPP and seeing how you can benefit from tax relief. Whether you're a basic rate, a high rate, or additional rate payer, there's some great benefits to be had from investing in a SIPP. The tax relief really is great and often overlooked in favor of ISA investing, when actually for some people, maybe the SIPP is better than the ISA. Just evaluate your circumstances and see which one's better for you, or as I'll discuss in a future video, maybe over the next week or two, maybe both accounts have a place in your strategy. It's not a case of either or, you can use both, you don't have to choose. As you can see in my strategy, I'm using both ISAs and SIPPs, And together, they'll allow me to achieve my financial goals, hopefully. So scrolling down to the allocation, this one's super simple. I've got a global index fund, State Street, SPDR, MSCI, All Country World Index. This one is the cheapest global fund at the moment with a TER of 0.12%, contains both developed and emerging markets, market cap weighted. And then we have a Russell 2000 small cap ETF. This one, it contains US small caps, but it has a quality filter as well. So in practice, Russell 2000 with a quality filter is very similar to the S&P 600. So that's it for the update this month. As you can see, it's been a very rocky month. If we add this up together, the ISA is down by 1,765 and the pension is down by 663. So well over £2,000 down this month. And we'll have to see what the next tax year has in store for us. Me personally, I might be switching some ETFs out, but I'm definitely not going to exit the market. I'm going to keep up consistent contributions, think long term, and just remember this is part and parcel of investing. I knew what I was getting into. I definitely didn't expect a journey like that. If investing was that easy, everyone would do it. The last thing I wanted to mention is that I have updated my ETF cheat sheet recently, the resource that helps you find, compare, and research ETFs with ease. All in one place. I have tabs for developed markets, emerging markets, global, USA and UK, and I've also recently added a leaderboard tab which shows the live, hopefully live, pull through from Google Finance year-to-date price returns of all the ETFs and ranks them in order, so you can see how things are stacking up so far, which ETFs, which regions are outperforming at the moment. Now, of course, past performance is no guarantee of future results, especially when we're talking about such a small time period, but it is cool to see what's doing well so far year-to-date. And on each individual sheet for developed markets and so on, you can see a lot more details about the ETF, all the basic details, the 1, 3, and 5-year total returns updated monthly, dividend yield, volatility, and I really hope it helps you with that foundation of discovering and researching ETFs and making informed decisions. And you can get completely free access to this by signing up to my newsletter in the link in the description. It's completely free and you can unsubscribe at any time. Let me know your plans for the end of this tax year or the start of the new tax year in the comments below. And as always, thank you for watching.